Almost every project horror story I've seen in delivery had visible warning signs long before the first brick was laid. The contractor was already wrong on paper. The damage was written into the appointment itself. In this video, I'll walk through exactly how I select a contractor, the checks I run before pricing, what I read in the tender response, and the red flags most owners and developers miss until the project is already in trouble. Quick note before we start. Most content on this topic comes from builders or from homeowners sharing their experience. Both have value, both are partial. What you rarely get is the view from a project manager, independent of the contractor and responsible to the project. That is the perspective of this video. I am Francesco Fasanella, co-founder of Habitat Investments and Habitat Living, and a chartered project manager. What follows in this video is not just theory, but it's what I actually check. Frame first. The selection of a contractor is not an administrative step. It is one of the most commercial decisions of the entire project. And indeed, most of the cost overruns, delays, disputes, and quality issues you hear about are decided the day the wrong contractor is appointed. The physical side has very little to do with it. Once you see the decision in those terms, what you look at changes. Which signals you take seriously changes. How much weight you give to the headline price changes. And most projects are lost before the contractor even starts. The first thing most owners miss. By the time tender prices are on the desk, half of the decisions that shape contractor behavior have already been made. Not by the contractor, but by the client and the design team. Contractor behavior is shaped by what the contractor received before pricing. Four things matter here: design readiness, scope definition, information quality, and procurement route. If those four are strong, a serious contractor prices realistically and behaves consistently. If they are weak, even a decent contractor is handed room to interpret, exclude, and carry hidden assumptions. And a less decent one is given a structure to abuse. Every REBA stage exists for a reason. Going to tender at REBA 3, when the scheme really needs REBA 4 for the procurement route you have chosen, is one of the most common and most expensive mistakes I see. The contractor doesn't have enough information to price properly. So what happens is that he either assumes conservatively and the numbers looks inflated, or he assumes aggressively and recovers later through variations. Either way, the client loses. Scope definition. A scope that is ambiguous is not neutral. It is a structure the contractor will read in his favor once issues arise. I have seen scopes that did not specify whether making good included redecoration or whether structural openings included cutting and sealing of services. And gaps like these become variation within the first 90 days. And then information quality. Drawings inconsistent across disciplines. Specifications that conflict with the drawings. Schedules that do not match the design intent. Serious contractor flags these in pre-tender requests for information, and how he flags them is itself a signal. What happens is that an unserious contractor prices them anyway, absorbs the ambiguity into his contingency, and uses it later. And now the procurement route, traditional, design and build, construction management, two-stage. Each allocates risk differently. Choose the wrong route for the scheme and no contractor on earth can rescue the project. A heavy refurbishment with genuine structural uncertainty, priced as a full lump sum design and build on outline information, is asking for disputes. A traditional route with a properly developed design gives the contractor a basis to price and the client a basis to control. A concrete example: extension plus refurb scheme tendered at REBA 3 with structural information labeled assumed subject to intrusive survey. The lowest bid came in 18% under budget. On paper, a win. By practical completion, variations and additional works had absorbed the entire underspend and more. The contractor priced what he saw and recovered what he had not seen. That is not dishonesty. It is the predictable outcome of going to tender without the information ready. If your project is arriving at the market in a weak state, the wrong contractor is already the most likely appointment. Selection begins long before tender returns. Now, the selection itself. I am not going to list hundreds of things. 5 matter most. Get these 5 right and you have filtered out most of the risk. Get them wrong and no amount of contract drafting will save you later. First, financial depth. The contractor needs enough cash to run the project without pressure. Not just to start, to run. If the appointment conversion involves a heavy pressure on advance payments, outsized deposits, or early front-loaded valuations with weak supporting evidence, that is a flag. A contractor who cannot absorb normal mobilization, preliminaries, and early procurement without financial stress will generate problems later. Financial weakness at the start does not heal as the project progresses. It compounds. So, get the last 3 years of account, look at trends, not just the latest year. Second, relevance of experience. Not generic experience, relevant experience. A contractor who has delivered 6 high-end residential refurbishments in the last 3 years is a different proposition from one who has delivered 6 new-build housing schemes in the same period, even if turnover looks similar. Loft conversions are not the same as heavy internal reconfiguration with the structural alterations. Residential is not commercial. Ask for projects matched by type, scale and complexity, and check references specifically on those, not on the portfolio they prefer to show. Third, the real team, not the company name. This is one of the most common appointment mistakes. You meet the managing director at tender stage. You feel reassured. 6 weeks in, you are dealing with a junior site manager who has never delivered a scheme of this type. The team you are sold is rarely the team that delivers. Fix this at appointment. Ask by name who the project manager, site manager, and commercial lead will be. Check their CVs and check which other current projects they are on. A contractor who cannot name the team is giving you a corporate promise, not a delivery commitment. And then, how they respond to tender. This is where experienced project managers do most of the filtering. Which request of information does the contractor raise? Are they precise and commercial or very general and defensive? How are the exclusions written? Are they clear or hidden in a long list? Does the qualification schedule make commercial sense or does it read as a future claims register? A contractor who raises 2 intelligent requests for information that force the design team to tighten a detail is worth more than a contractor who raises none and quotes anyway. On price, a number materially below the others is almost never good news. It usually means the contractor has missed something, misread something, or he intends to recover later. I would rather appoint a contractor at the median with a clear basis than the lowest with an unclear one. And then the program. Everyone promises speed at tender stage. Fewer explain how. Does the program reflect the real sequence of work? Are long lead items identified and protected? Is the labor curve realistic? Is there actual float? Or is the program front-loaded with optimism? A program that assumes zero weather impact, uniform productivity and perfect procurement is a sales document, not a delivery plan. So what are the red flags that experienced project managers spot early? Some signals you learn to read over years of delivery, and these are the ones I watch hardest. The very low price. When a bid comes in 15 to 20% below the average, with no clear reason, something is off. Either the scope has been read differently, or the pricing strategy is to win the appointment and recover later. Every experienced project manager I know has been caught by this at least once. The test. Ask for a detailed pricing breakdown, not just totals. If the breakdown cannot be produced or does not reconcile, that is the answer. And then the informal process preference. Serious contractors may grumble about paperwork, but they work with requests for information, written instruction, payment applications, variation tracking, program updates, and quality records. Contractors who prefer everything on WhatsApp, over the phone, or in site conversation without follow-up are telling you something. When the project enters stress, the informal approach becomes untraceable, and untraceable almost always ends with the client absorbing the cost. So I would treat this as a structural incompatibility, not a style preference. Financial tightness at mobilization. If the contractor is chasing the initial advance harder than the scope, asking for front-loaded valuation patterns, or needing the first payment before he can demobilize the previous project. Those are not negotiation tactics. They can be cash flow signals. And so the same pattern repeats. A contractor tight at the start generates claims, variations, and commercial pressure throughout the project. It doesn't get better at month 6. Vague answers to hard questions. At interview stage, and this is an interview even if nobody calls it that, you are testing how the team thinks under pressure. Ask about a recent project that did not go well. The honest answer is useful. Instead, the defensive or evasive answer is the warning. We want a contractor who can describe a real problem, the cause, the resolution, and the cost impact in clear terms. If the answer is we don't have projects like that, the conversation is over. Weak subcontractor chain. Even under a traditional contract, the visible contractor depends on a chain of subcontractors. Who are the key trades? Are they long-term relationships or cheapest available on each project? A contractor with stable subcontractor relationships has pricing leverage, quality control, and coordination advantages. One rebuilding his chain every project is carrying coordination risk straight into yours. And a second concrete example. 2 contractors tendering the same scheme. The cheaper one came in 12% below the average. He could not produce a detailed breakdown, listed 3 references of a different project type, and preferred flexible arrangements on payment. The other tendered at the median. He raised 4 pre-tendered requests for information on drainage, on structural openings, and on conflict between the architect and the M&E drawings. So, same project, 2 completely different appointments. Who would you go with in this case? Probably, going with the second one would recover the premium within 3 months. What you protect with structure. Even a strong contractor underperforms under weak documentation. Selection alone doesn't protect the project. Contract structure matters. For a refurbishment or mid-scale redevelopment around 200 to 500,000 pounds with some complexity, a JCT intermediate contract gives you the process and protection JCT minor works cannot. For larger or more technically complex work, move to JCT standard. The wrong contract at appointment is one of the quiet commercial errors of the sector. It decides what tools you have when something goes wrong, and something goes wrong on every live project at some level. Then the payment structure. Resist heavy front loading. Valuations tied to real work in place, not to optimistic percentages. Retention is a legitimate commercial lever on most schemes of scale. Waiving it removes your main tool over snagging and defects. Advance payments that cannot be clearly tied to identifying long lead procurement should be refused. Insurance verification. Actually check the policies. Check the limits. Check the excesses. Check they are in force for the whole construction period plus any defects liability period. I have seen more than one project where the insurance turned out to be either lapsed or insufficient precisely when it was needed. And do not trust the certificate alone, trust the policy. Responsibility allocation. Who is responsible for what? In writing before work starts. Particularly around temporary works, design portions, and interfaces between trades. Ambiguity at this level becomes disputes later. The point here is that selecting the right contractor is necessary, not sufficient. Documentation, payment structure, and contract choice give you the framework that protects the selection. So, back to where we started. Almost every horror story I've seen had visible warning signs long before the first brick. Financial weakness at the start. Generic experience sold as specific. A real delivery team quietly different from the one presented. A price too low to be real. An informal process preference. A program built on optimism. So the contractor selection is not an administrative step. It is one of the most commercial decisions of the project. You are not just buying a quote, you are appointing a delivery structure. Some disputes are normal on every live project. Instead, horror stories almost always had clear warning signs. And if you want more on how delivery actually works from the operator's side, follow the channel. More to come.